Good evening, everyone, or good morning, good afternoon, depending on whichever part of the world you are joining us today. Welcome to another ASBxSEACEN seminar, online seminar on macro finance and emerging markets. And today we are very happy and privileged to have Professor Anusha Chari from the Economics Department of the UNC in Chapel Hill in North Carolina, who will talk to us about spillovers at the extreme. And the only advertising that I would like to do is our forthcoming seminar. That's the next one, the April edition, by Victoria Ivashina from Harvard Business School. Why is dollar debt cheaper? Evidence from Peru. That will be in early April. We'll advertise the dates later. But we are really privileged and happy to have Anusha with us today. She is an extremely well-published and well-known international macro expert, especially on emerging markets. And we really hope that we can have her in the region in some better times, in not so distant future. In terms of questions, can we please wait? Can you please send your questions in the Q&A function? We will come back to questions at the end of the seminar. We'll have enough time for questions. That's all from me. Thank you. And Anusha, the floor is yours, or the screen is yours.
Thank you so much, Azir, for this kind invitation. It's a real pleasure to be here. So let me go ahead and share my screen, and we can get started. So can you confirm that you can see my screen?
Yes, we can.
Okay, perfect. So before I get into the meat of the talk, let me sort of introduce my co-authors. So the first co-author is Carly Dill Stedman, who is from the Federal Reserve Bank of Kansas City. And since she's on the paper, the usual disclaimer applies. And the second co-author is Kristen Forbes from MIT and the Sloan School of Management. And many of you may be familiar with her work. So let's get started and talk about this paper, which Azir mentioned. The title is Spillovers at the Extremes. And what we're going to be looking at is the ex-ante macro-prudential stance that countries have adopted, and what this means for the vulnerability of these countries to different phases of the global financial cycle. So by way of motivation, let's get started by talking about the fact, as all of us know, countries around the world have used macroprudential policies more actively in the aftermath of the global financial crisis. And this has primarily been to reduce the buildup risks during good times when borrowing costs are low and leverage tends to rise in the financial system, and mitigate the amplification of shocks during bad times. So macro-pru as a means to mitigate the boom-bust cycles in credit growth that we have seen over the years, especially in emerging markets. Growing body of literature assesses these policies and basically finds some success in the ability of these policies to achieve specific domestic goals. And these include moderating growth or in terms of sort of moderating the levels of foreign currency denominated borrowing. But if we look at these policies and their effectiveness by other metrics, such as stabilizing cross-border capital flows more broadly, we find that there is limited success on that front. And in fact, there is growing evidence these macroprudential policies can lead to risk shifting to other parts of the financial system, generating spillovers and leakages. So in terms of non-bank financial intermediation, the risks shifting to that part of the financial system. So what we are really interested in is looking at whether and how these magnitudes of these spillovers and leakages can be large. What are the circumstances where these leakages or spillovers may be particularly salient and make the financial system more vulnerable to these shocks? When we started this paper, we found that there is very little systematic analysis of what these spillovers and leakages imply for different phases of the global financial cycle. So the question that we are going to ask is, how do macroprudential policies, and by macroprudential policies, I really refer to an ex-ante macroprudential stance that a country has adopted, how do they affect portfolio flows? And here I mean portfolio flows in the form of bond and equity flows across borders at different phases of the global financial cycle. And we're going to do this by linking to literature. So I just mentioned the literature on the efficacy of macroprudential tools and how this might impact spillovers and linkages. But there is another part of the literature which is rapidly growing, which is looking at taking more seriously the distributional consequences of global risk shocks on capital flows and returns. So instead of just focusing on measures of central tendency like the mean and the median, as much of the capital flows literature does, this is sort of focusing on extreme events. And I just sort of like to flag that this is sort of the genesis of a methodology that could be used for stress testing capital flows. So we've talked a lot about stress testing at banks, but this is a methodology that focuses on the distribution of outcomes with particular emphasis on tail risk. And so what we are going to try and do in this particular paper is to link these two literatures, which is to see what happens if countries have adopted particular policies. How does that interact with these global risk shocks? And do macroprudential policies, it's an open question, do they mitigate the impact of these global risk shocks on these other financial intermediaries, such as bond and equity investors, or does the fact that a country has adopted a tighter macroprudential stance, does it make it more vulnerable to these extreme tail events? So what we really want to see is, does tighter macroprudential policy, does it spill over and shift risk to the other parts of the financial system? So what we are going to do, and our approach is going to be to pay careful attention to these different measures of the macroprudential stance. And rather than just adopting a dummy variable approach, what we try and do is to construct a measure of the intensity of the macroprudential stance. And we also can look at the granularity by sort of drilling deep and looking at disaggregated measures of the macroprudential stance, which could include ranging from loan to value ratios to countercyclical capital buffers, demand side measures, supply side measures, etc. So we want to take a detailed look at the impact of these different tools in terms of these risk shifting, potential risk shifting that could occur. And much of the literature suffers from an endogeneity issue, which is that countries may tighten macro-pru in response to some sort of global exogenous global shock. So I will walk you through how we adopt a policy shocks approach to extract the orthogonal component, which is not related to observables, of the and to extract this exogenous component of a country's macroprudential stance. The second ingredient we need once we have these measures of intensity and the macroprudential stance is to have a good measure of global risk. And this what is colloquially known as risk on, risk off, to actually develop a measure, which I did with Carly and another co-author, Christian Lundblad, in another paper that focuses squarely on capital flows and returns and non-bank financial intermediaries in the form of closed-end mutual funds, both bond and equity funds that are investing in around the world. We also have this for that purpose, for these portfolio flows, we use a high frequency detailed portfolio data from the EPFR. And these are weekly flows in terms of bond and equity flows that we combine with the global risk on, risk off shock metric, and looking at the ex ante macroprudential stance. We supplement a little bit with the IMF data on international capital flows that doesn't focus so narrowly on bond and equity flows, but includes banking flows as well. So it's a broader range of investors, but it's a quarterly frequency. And what you're going to see is the fact that we have this high frequency approach where the global risk shocks are at high frequency, the portfolio data is at high frequency. When we combine that with the ex ante macroprudential stance, we are actually able to uncover some effects in terms of the interaction of the macroprudential stance with the risk on, risk off states of the world. And so this is essentially what we're going to do to analyze the impact of these global risk shocks, the macroprudential stance, and how they interact with portfolio flows. And what you're going to see is that we can focus on marginal effects. So if you have a tighter ex ante macroprudential stance, how does this interact with risk at different points of the risk distribution rather than just focusing on the mean or the median? So let me sort of give you the punchline. What we find is that if we look at unconditional sort of regressions of capital flows on the risk on, risk off stance during normal times, for example, at the mean of the distribution, what we find is that an increase in global risk, which would be characterized as a risk-off state of the world, leads to unconditionally leads to a significant decline in equity and debt flows. And if we look at unconditionally, we look at the macroprudential stance, a tighter macroprudential stance modestly impacts equity and debt flows. But the effects you will see are not very significant if we just look at the macroprudential stance in an unconditional way, which is why the literature has sort of failed to find the impact of macro-pru on measures of capital flows. When we interact the ex-ante macroprudential stance with the risk on, risk off regime, what we find is that macroprudential regulations amplify the impact of risk shocks on bond flows. And this is sort of somewhat of an unexpected result, but is consistent with the risk shifting and the spillovers and leakages that I was mentioning just a couple of minutes ago. And so what we find is that if a country has an ex-ante tighter macro prudential stance, then in response to risk-off shocks, we see increased outflows in terms of debt and equity outflows, bond and equity outflows. And in response to risk-on shocks, where the risk appetite of global investors is increasing, we see increased inflows. It becomes clear that it is important to focus on the entire distribution of the capital flows as well as the risk shocks, because these magnitudes of these effects are very moderate at the mean or the central part of the distribution, but we find very large and significant effects of this interaction between macro pru and portfolio flows on the extremes, or if we look at the tails of the distribution. And this is particularly salient during risk-off periods. In terms of instruments, we find that the magnitudes are larger for bond flows than equity flows. And when we dig deeper into the granularity of the instruments, we find that these effects tend to be driven by tools that are targeting specific risks. For example, foreign exchange regulations that are designed to limit the banking system's exposure to foreign currency denominated loans, loan to value ratios that are targeting the mortgage market, and various measures of bank credit supply that range from capital measures such as CCYB or conservation measures or an extra surcharge on systematically important financial institutions, more general measures like liquidity and reserve requirements, as well as policies that are designed to moderate credit growth when interest rates are low, loan loss provision requirements, etc. So the interesting thing is that when we look at a more generalized measure, such as the capital buffer tools like the CCYB, we find evidence of less risk shifting. So the bottom line is the more specifically targeted policies tend to have a bigger risk shifting impact than the more generalized capital buffer tools. And I want to emphasize that our paper is not suggesting that macro pru be diluted or rolled back, but that we sort of take the sort of spillover and leakage implications or risk shifting implications into consideration when designing a macroprudential policy package. And once again, I'd like to emphasize the importance of stress testing capital flows in the context of different types of macroprudential tools. So the key implications of our research are that our findings support concerns that macroprudential regulation shifts some financial intermediation that can increase the vulnerability to the global financial cycle, particularly in response to risk-off shocks. And it stands to reason that this needs to be weighed against the benefits, such as improving the resilience of the banking system. And what we find in summary is that the role of an ex-ante macroprudential stance varies across the global financial cycle, and standard analyses might miss these important interactions at the different points in the risk distribution, especially at the extremes. So what I'm going to do next is to talk us through the data and the methodology in terms of how we construct the macroprudential stance, our risk and portfolio flow measures, and our methodology to assess the impact of this interaction between macro pru and global risk shocks. And the key results are going to be organized using this portfolio flow data I'm going to present the baseline analysis, which is going to use more aggregated measures of the intensity of the macroprudential stance. Then we'll sort of drill deep and look at the granular measures, and then I will briefly tell you about the additional tests that we did, and then we can conclude. So let me sort of start off by talking about the macroprudential stance, then we'll move on to the risk measure and other controls, and then we will talk about the final data set. So it's important to emphasize that our measure of the macroprudential stance is ex ante, before the risk shocks hit. We are trying to capture the intensity of the macroprudential stance by including a range of tools. And we rely on two main data sets to come up with these measures. So the CCYB data is very timely. So we have it, up until 2020, we include those measures, which is very helpful because CCYB measures were relaxed during the COVID crisis. These data are from the European Systematic Risk Board and the BIS, so they are very timely. The IMAP data from the IMF is the second data set, which includes the loan to value levels, as well as a range of tools, including foreign currency targeted macro-pru. And so what we're going to do is that we are going to construct the macroprudential stance by aggregating changes since 2000. And we have four main indices. Our preferred measure is the broad intensity index of macro-pru, which is an equally weighted index of the normalized values. So we take the measures and normalize them by the standard deviation of the countercyclical capital buffer, and the LTV ratio and the FX stance. So the CCYB and LTV, we actually have quantitative numbers on this. The FX stance is we sort of compute it by aggregating net tightenings over time. So it's sort of an aggregated measure where, if a country is continually tightening its FX-based macro-pru measures, then those are aggregated. The narrow index just focuses on the first principal component of the CCYB and the LTV. We have two additional measures, which is the country relative dummy, which looks at whether for a particular country, the aggregate macroprudential index is greater than the annual median for all the other countries in a particular quarter. So does a country have a tighter stance relative to other countries in the sample? And this captures sort of, the cross-sectional heterogeneity. We also have the time relative dummy, which is basically aggregating the macroprudential stance over time, and if a country has an aggregate MP stance index which is greater than 1, we consider that as a tightening. So this sort of captures the across time effects and can capture the more recent changes in response to COVID-19. And this picture basically shows us how the macroprudential stance for the countries, 55 countries in our sample, has evolved over time. And the red line is really our preferred measure. And we can see this picture clearly depicts the fact that before the global financial cycle, macro-pru was relatively less in use, and it has ramped up considerably over the last decade. And the nice thing about our broad measure, which has the CCYB and LTV, is that we see this relaxation in the early months of 2020. Now turning to our risk measures, as I mentioned, we have this risk on, risk off measure of risk from this other paper. And the main idea here is to capture the realized variation in global investor risk appetite. So what we do in this paper, in this other paper, is to disentangle the price of risk from the quantity of risk, and the price of risk reflecting time-varying global investor risk aversion, whereas the quantity of risk is basically physical risk or global macro uncertainty. And we do this by using several series, so 15 series, and we take a z-score of the principal component of the daily changes. All of these series are normalized and written in a way such that a higher value indicates risk-off states of the world. And these series capture credit risks such as the BBB corporate bond index, which is option adjusted for options, risk aversion by relying on measures such as option implied volatility and the VIX, the VSTOXX index, and so on, as well as a weighted measure of advanced economy equity returns. It's important to mention that rather than just taking a US-centered focus in the construction of this measure, we are looking at sort of a broader measure that includes Europe as well. And so we have the European series also feeding into our risk-on-risk-off index to get a broader set of investors who are domiciled in the US and Europe. We have measures of funding liquidity, which are the G spreads on the 2, 5, 10-year Treasury bond index, the LIBOR OIS spread, the 3-month Treasury spread, and a few other series in there, as well as the broad US dollar index and gold prices. So the risk-on-risk-off index combines all of these series and then tries to extract measures of global investor risk aversion and physical risk, relying on a structural model which allows us to extract these measures. And if we look at here, I'm showing you the time series. We can see that there is considerable volatility in our risk-on-risk-off index. It spikes at all the times you would expect it to, such as the global financial crisis, the European sovereign debt crisis, and so on. And then, right at the end here, you can see the massive spike during the COVID-19 shock. And if we look at a distribution of this risk-on-risk-off index, it is highly right-skewed, which is skewed towards downside risk or risk off. And it also has very long tails, which suggests that with long tails and fat tails, extreme events not only become more probable, they become potentially more destabilizing. The other variables are our portfolio flows, which are from the EPFR. And these are weekly flows for over 14,000 equity funds and 7,000 bond funds. We combine this with the country weightings data from EPFR to see how these funds are allocating their portfolios across different countries in the world. And the advantages are that it is high frequency at the weekly level and a good representation of fund managers domiciled in the US and Europe. The disadvantage is, of course, it's a narrow measure. It omits certain investor groups and only focuses on portfolio equity and debt flows. And we need to sort of interpolate these allocations because we're combining it with the country weightings data. So this is sort of important to sort of recognize that it is different in coverage from the IMF data on international capital flows. Other standard controls are push variables from advanced economies, which is the advanced economy monetary policy stance that we use for 4 major economies, which is the US, UK, the Euro area, and Japan. And we're focused on Krippner shadow rates in order to sort of take into account more conventional interest rate tools, as well as the unconventional monetary policy tools, as well as the advanced economy industrial production index. The pull variables, which are from the destination country side, are the exchange rate regime, the exchange rate volatility with respect to the dollar, the interest rate differential of countries vis-a-vis the dollar, financial openness, institutional quality, as well as real GDP growth. And so this gives us our final data set, where we have 55 countries from both advanced and emerging markets. And this 55 is basically constrained by trying to have controls, all these aforementioned controls for all of these countries. We exclude the safe haven countries, namely US, Japan, and Switzerland. So just to kind of give you a pictorial view of what we see in terms of ex ante, the macroprudential stance, for both bond and equity flows, the red line is basically countries with a looser stance, and countries with a tighter stance are in blue. And just at first pass, we can see that in response to risk-off episodes, we see that these portfolio flows, the outflows for both equity and bonds, are much more significant for countries with a tighter ex-ante macroprudential stance, with the impacts being more significant for bond flows. So flows decline by 10% more for countries with tighter macroprudential stance. If we look at risk-on episodes separately, we see once again that flows, the flows are more volatile in response to risk-on shocks, where global investor risk appetite is high, borrowing costs may be low, encouraging more capital flow into these countries. So let me sort of describe our methodology. So I had mentioned that, we want to take this reverse causality or endogeneity problem that much of the macro-pro literature faces by adopting a policy shock approach. So the first stage regressions are really, we're looking at our measures, our four broad measures of the macro stance. And we are sort of combining this with an 18 series, which are capturing crisis. So, the count of sovereign banking and other crises, whether a country has recently experienced a crisis, alternative measures of credit growth for real GDP growth, and a variety of controls. So the idea is that let's look at a range of controls, observables, that could drive countries to adopt a tighter macroprudential policy or loosen it. And once we have controlled for these observables that could be drivers of macro-pro, then what we are going to do is to use the fitted value from the first stage, which is this MPIT hat, and subtract it from the macroprudential stance that we observe to get this MPIT tilde, which is our policy shock, right? So this is orthogonal to the observables that we have fed into the first stage regression. So this is a policy shock, which we argue is orthogonal to the observables. And these are 18 series, and the crisis measures are as follows. Has there been a crisis in the last 12 months, a measure from the BIS of distance default, and various counts of different types of crises, credit growth, measures of credit growth, the cross-border ratio, domestic credit growth, the growth in housing prices, in terms of growth, real exchange rate appreciation, what is the real GDP growth forecast, expectations, and so on, and some institutional measures, as well as openness, FX volatility, what is the exchange rate regime, etc. And what you can see is that the broad index is in blue, and these are the sample means of our 4 measures. You can see them ramping up and then declining at the end of the sample period. If we delve deeper into the broad index, we can sort of see what this looks like for across the distribution, where the blue line is the mean, the red line is at the 90th percentile in terms of the broad intensity index, and the 10th percentile is here. So once we have these policy shocks in hand, we can do our second stage analysis, which is to look at the interaction of the macroprudential stance with the risk shocks. So here we have our capital flow measures. These can be bond or weekly bond or equity flows. We have country fixed effects. We look at the unconditional impact of macro-pru. We look at risk unconditionally, global risk and unconditionally, and then we look at the interaction of macro-pru with risk, conditioning and controlling for these advanced economy push variables and the destination country pull variables. And so we are going to focus on these betas. So we expect this ex ante impact of macroprudential policy to be negative, in that if macroprudential policy is tight, ex ante, we might expect that this acts as a moderating influence or reduces the amplification on capital flows. The risk measures, as we saw once again, is negative. The impact of risk shocks, risk-off shocks, is to amplify outflows, and risk-on shocks is to amplify inflows of capital. And then we are basically looking at this interaction between macroprudential policy and risk. And we expect that if there are spillovers or risk shifting, a tighter prudential stance would amplify the impact of risk shocks. So risk is shifting from the banking sector to non-bank financial intermediation. So let's go over the results. In terms of the unconditional effects, you can see that the unconditional macroprudential stance, and recall that this is being estimated at the mean of the distribution, we don't really find much significance. So we might conclude that macro-pru doesn't impact capital flows such as bond and equity flows. But if we look at the unconditional impact of global risk, it is highly significant and has a negative impact, negatively correlated with capital flows. So risk-off shocks, outflows, risk-on shocks, inflows. And what we see is that if we increase the risk-on, risk-off index by 1 unit, weekly bond flows decline from about 0.09% to 0.1%. And in terms of the dollar value impacts, this is a decline. A risk-off shock leads to weekly portfolio outflows of 2.3 billion to 2.4 billion in our data set. And so this is what we are focusing on. Now, if we want to look at the conditional impact or the interaction of the ex-ante macroprudential stance with the global risk measure, we see that this is negative for 3 out of our 4 measures, which suggests, and you can see that the coefficients are also going up in magnitude, which suggests that a tighter ex-ante macroprudential stance amplifies the impact of the global risk shocks. Now, once again, these effects are being estimated at the means, and what we see is that if we combine a tighter ex-ante macroprudential stance with an increase in the RoRo risk on risk off index by 1 unit, bond flows declined by about weekly by about 151 to negative about $500 million. And in terms of assets under management at the start of 2020. But this is sort of these impacts, if we're just looking at the mean, they're moderate compared to the unconditional impact of a 1 unit increase in global risk, which I showed you on the previous slide, which corresponds to outflows exceeding 2 billion, right? So this makes a case for looking at different points in the risk distribution. And this is what we do, which is we look at how do capital conditional on an ex-ante macroprudential stance, how do capital flows respond in response to global risk shocks, right? So we're taking the ex-ante macroprudential stance and we're comparing a tight versus loose macroprudential stance. So if you have a loose macroprudential stance and versus a 1 unit increase in the macroprudential stance, and then looking at the impact at different points in the risk distribution. So to be clear, it's ex-ante macropru interacted with points in the distribution of global risk shocks. And what we see here, if we begin with extreme risk off, which is at the lower end of the bottom part of the slide, we see these highly negative coefficients for both the broad and the narrow intensity index in the tails, right? So if we're looking at a risk at the point in the distribution of risk at the 90th percentile, 95th, 99.5. So we're going deeper and deeper into the left tail of these global risk shocks. We see these very significant impacts. You can see that the magnitude of the coefficients is increasing. And conversely, if we look at risk on, which is the right tail, we see that risk at 1%, 5%, 10%, which is again going into the right tail. We see that these magnitudes are much larger at the extremes. And if we, in contrast, just focus on the median or at the 75th percentile, we would erroneously conclude that there are no significant impacts. So these impacts tend to be focused on the tails of the distribution. So they have these large effects at the extremes. And if we put dollar values at this, on these numbers, risk off at the 95th, 99th, and 99.5 percentile lead to outflows ranging from 670 million to over 2 billion. So if we think about what that these impacts, these are over and above the impacts on the unconditional risk shocks, and the tighter ex-ante macroprudential stance can amplify the impact of these large risk off shocks on bond outflows by 45 to 67%. And if you want a visual depiction, this is how our coefficients of our marginal effects, which is really that interaction effect at different points of the risk distribution, look like. On the left-hand side, we have extreme risk on. On the right-hand side, we have extreme risk off. And you can see that the risk off impacts are greater than the risk on impacts. Then, as I mentioned, we can look at the granular macropru measures, and we can focus on 2 measures of intensity, which is CCYB and LTV, and we can calculate the aggregated MP stance for 3 types of policies based on the IMF's IMAP data, which are FX-related, demand for credit, and bank supply of credit, which are aggregating these dummy variables. And we repeat our analysis for the unconditional and conditional regressions, as well as look at the marginal effects. And once again, what we see here is that the impact of global risk is sort of consistently negative on all of these granular measures. But the negative impact of the amplification effects both in significance and magnitude, varies across tools. So we see these bigger effects on LTV, affect targeted measures and supply measures. As I mentioned, those were the capital measures, loan measures, and general measures. Whereas for CCYB, we don't really see a significant effect. So this is basically telling us that there is these are the magnitudes of this interaction effect. But we're really interested in is how does this look like at different points of the risk distribution. And once again, you can see that for these three macro granular measures, LTV, FX measures, and supply-based measures, we see these significant impacts on the tails of the distribution, both for bigger effects at risk off and significant but smaller effects for risk on. And so the amplification effects vary across these tools. They are largest for these three measures and supports evidence on risk shifting in the financial intermediation from these FX-based measures, LTV measures, as well as these supply-based measures. So we did a bunch of additional tests, and I think I'm almost out of time. So let me just tell you briefly, we repeated the analysis for equity flows. We saw similar patterns, but more moderate effects. We compared advanced economies with emerging markets. The key patterns were unchanged, but emerging market bond and equity flows are more sensitive to risk shocks. There is no difference in the interaction effect for emerging markets and advanced economies using our broad intensity index, which is our preferred measure. But the dummy-based indices suggest that the amplification is stronger for advanced economies, mostly driven by supply measures. We looked at currency of denomination, and that didn't really seem to play much of a role. We looked at other forms of capital flow management, such as conditioning for capital controls. And we also looked at this lower IMF data on lower frequency. We did other sensitivity tests, which is to drop the COVID period, focus exclusively on the post-GFC period, include the safe haven countries of the US, Japan, and Switzerland, as well as other measures of risk that are popular in the literature, such as the VIX. And so I won't go into this international flow data from the IMF, but here we do find the impact of macro-pru on moderating risks in the banking flows, right? So the target, if we're targeting the banking sector of the financial system, macro-pru seems very effective in moderating those risks. But what we have documented in this paper is the spillovers to other parts of the financial system and other financial intermediaries. So let me conclude by saying that what we have seen in this paper is the impact of macroprudential regulations on portfolio flows tends to be small during normal times and also in the risk distribution, but we see these large significant effects on the extremes, especially for risk-off periods. There are important interactions between the ex-ante macroprudential stance and the global financial cycle. In particular, a tighter ex-ante macroprudential stance appears to magnify the impact of risk shocks on bond flows, and the granularity or the type of macroprudential tool matters in our analysis. And let me conclude by saying that, in summary, our analysis supports concerns that macroprudential regulations may shift shift risk to financial intermediation to sectors that may be more vulnerable to risk shocks in terms of in terms of global risk shocks, being sensitive to subscriptions and redemptions from their investor base domiciled in advanced economies. And it stands to reason that these concerns need to be weighed against the benefits of macroprudential regulation in terms of fostering banking system resilience. But I think what the question I'd like to leave us with is that our results sort of seem to suggest that maybe we need to be paying more attention to the regulatory perimeter, as well as, perhaps increasing an emphasis on stress testing for capital flows. So thank you very much for inviting me to present, and I'd be happy to take questions now.
Okay, thank you, Anusha. Thank you very much for what I was basically expecting, which is a very careful and thorough econometric analysis of a whole bunch of issues. And I take comfort from your findings that you showed at the very end, which is kind of what, I mean, it gives me comfort because this is what we were hoping for, and this is what we thought how macro-prud tools would work, and how they work, and so on and so forth. I know that Hans has his hand up, but I will shamelessly abuse my sort of position as moderator to ask a couple of sort of smallish questions, mainly for my own understanding, because I may have missed it in the presentation. And I admit that some of them are sort of cheap shots, but let me start with the risk on, risk off series, which you said is not only based on US series, but there are some European series on there, and so on. Mm-hmm. Now, my fear is, and I don't know enough about the co-movement and the interdependency, what may be a risk off in the US leading to a risk on in Europe, such that these measures sort of equilibrate each other if you aggregate them up. I mean, I didn't see that in the actual data, but is there a sort of a danger that these more complex aggregates, such as the RoRo compared to whatever the VIX or the MOVE or something, sort of have this offsetting factor? And the second point, if you allow me, you talk a lot about the global financial cycle, but you don't actually use the global financial cycle. You use a sort of indirect measure of the global financial cycle, which are these intensity indices. Are we implicitly assuming that these measures co-move at the same time as the global financial cycle? Or, I mean, there may be that these broad measures go up with a delay or react with a delay to the actual unobserved global financial cycle. Is that a problem or not? Thanks.
Okay, so let me sort of answer those two questions. So we developed the broader RoRo index precisely because we didn't want to have just a US-centric view, right? And one of, so if you look at the global financial cycle literature, what is popularly used, everyone just uses the VIX index, which is, first of all, very narrow, right? It's just focused on sort of option implied volatility for equity investors. It's not focused on credit risk. It's not focused on the liquidity in global markets and so on. So I think you make a fair point that by lumping Europe and the US together, there might be some attenuation, right? So the idea is that if they're canceling each other out, we're not going to capture anything, and therefore we wouldn't find any significant effects, right? But the other thing that I didn't get to see, because I didn't want to keep talking about the other paper, is that what we're really trying to do is to use a dynamic asset pricing model and a structural model separate out, because the VIX, once again, it conflates measures of risk aversion with global macro uncertainty, right? Sort of physical risk. So the name of the game was to really look at the to kind of disentangle the price of risk or capture global investor risk aversion, right? Because that interacts with this non-financial intermediaries, particularly the closed-end mutual funds that we're looking at in terms of the funding shocks that hit these funds, right? And then translate translates to these capital flows going in and out of these countries. Someone is mentioning that my sound is breaking. Are you not able to hear me? It's fine. Okay, so that is one point, right? That if these effects are crossing each other out, then our results suffer from attenuation bias, and we wouldn't be finding significant impacts. Second point is really trying to disentangle risk aversion from risk. And to your point about, are we really looking at the global financial cycle? We're focusing on different points in the risk distribution. So the idea is really, if in terms of the global financial cycle, we expect when it's going up to be in risk on, and when it's going down to be in risk off, right? And then if you do kind of a validity check, you basically a sanity check, we see that our index spikes precisely when conditions are tightening, in advanced economies, and then it becomes looser when, you have a credit boom. So those are my two answers, but great questions. Thank you so much.
Okay, thanks, Anusha. Hans has been very patient, so let's have Hans's question next, and then Ellie.
Thank you, and thanks for a really, really interesting paper. It contains so many things that it's sort of hard to get one's head around all of them at the same time. But anyway, I don't think you mentioned one sort of margin where you can have spillovers, and that's between countries. If one country tightens, another country does not tighten macro-prudential policies. Are there spillovers in that sense, that flows go to the country that haven't tightened yet, or so on? Can you do that with your data set, or have you done it?
We haven't done it, and our focus was really on, because of this reverse causality issues, we really wanted to sort of classify countries as having a tighter stance ex ante, right? So we weren't looking at kind of feedback loops, right? Where one country tightens, and so capital flows go to another country. So we weren't looking at these cross spillovers because of the tightening of macro-pru in one country driving capital flows to another country. But actually giving us a really interesting idea, because what we could do is, instead of looking at, the country relative measure is doing that, right? So, which is that the way the country relative measure is constructed is every quarter we look at a country and see, does it have a tighter stance compared to all of the other countries in the sample, right? So that is one way in which we're capturing, but I'm sort of thinking about, is there a way we can introduce, like basically exclude the country in question and look at the the macro-pru stance in other countries, or just introduce the macro-pru stance, country by country. There might be ways in which econometrically we could try and identify that. But we were really concerned about this: do countries endogenously tighten macro-pru in response to capital flow volatility, in which case the identification would be really problematic. So that is why we sort of look at the ex ante macro-pru stance and then look at what happens if we have a risk shock.
But I mean, you can still use the ex ante measures and say, if one country has recently increased this ex ante measure relative to another, do capital flows will there be capital flows from that country to some other country?
Mm-hmm. Yeah, no? We can do that. We can look at the cross country spillovers. We can do that.
Okay. All right. Thanks.
But we haven't done it.
Okay, Ellie, do you want to ask a question?
Sorry, I think someone's controlling the. Okay, can you hear me?
We can.
I have. By the way, it's very interesting, very comprehensive, and it's a lot of work. And I'm gonna suggest more work. But 3 questions. One on the back to all these attenuation bias. It's possible that the global financial cycle is really the U.S. financial cycle. It's, you know, Ellen Ray said it's basically U.S. monetary policy. Mm-hmm. So why not use that? Why not use U.S. monetary policy shocks as one possible measure of the cycle, A, and B, when you look at your index, there are obvious spikes, right, in the index. That suggests maybe it's good to look at events rather than a whole regression, just do event studies around those spikes. Would you get the same conclusions? Yeah, because you're doing the extremes, as you say, and those spikes are extremes, but they lead to very simple event studies. Third, your equation, your main equation has push and pull factors. You control for push and pull factors. Presumably, your risk measures are taken out of the push factors. There's other than your risk measures, but nonetheless, I'm curious to know what you get. Is that in the literature? I think my summary of the literature is push factors dominate when it comes to capital flows, and certainly when it comes to credit spreads, CDS spreads. That still be true once you control.
Yes, absolutely. So let me just sort of start from the end, which is that the advanced economy push factors are very, very salient in our data. And we sort of separated out when we're looking at constructing the RoRo index. We just focused on credit, advanced economy, equity markets, liquidity, and gold, and the US broad dollar index. And in terms of the push factors that we have, which is we have the advanced economy monetary policy stance, right? But it's for the 4 largest economies. It's not just US monetary policy. We have the US, UK, the Euro area, and Japan. So that is, you know, and the other push factor that we use is the advanced economy industrial production growth, right? So that's telling you whether countries are in booming or, you know, they're in expansionary phases or recessionary phases. So that is as far as the push factors are concerned. As far as looking at US monetary policy by itself, so we're looking at these 4 countries, 4 major economies. As far as the US monetary policy is concerned, I'll sort of shamelessly plug another paper that I have, which is called Taper Tantrums, QE, its aftermath and emerging market capital flows. So there we were focused on emerging markets, and that paper was published in the RFS. And that's where we do this high frequency identification of US monetary policy shocks and look at the spillovers to emerging markets. And what we don't have in that paper is the interaction with macro-proof. So, the innovation in this paper is to use our newer measure of the RoRo index, which is this comprehensive risk-on, risk-off index, because we found that both in policy circles and in the financial press, people are constantly talking about it's risk-on, it's risk-off. We were like, how do you actually measure it, right? And that's what we were trying to do with this measure. And so, I think you're giving me another idea that maybe we should go back to that taper tantrums paper and then try and do a kind of a smaller paper that is going to kind of interact, just focusing on macro-proof and the interaction with US monetary policy shocks. So that's definitely a possibility. As far as event studies, again, in the RoRo paper, that's exactly what we did, right? So I mentioned stress testing for capital flows. So what I did, because, what you see is that different risk factors come to the fore at different points of stress. So global financial crisis, credit spreads, and advanced economy equity volatility were very important. COVID crisis, we see that funding shocks come to the fore. So this methodology of using these distribution of risk shocks can absolutely be applied to events, right? In fact, it can be used for this type of stress testing by looking at, well, what were the drivers, the granularity were the drivers for different events. In the RoRo paper, we look at the COVID crisis, because when we first started writing that paper, it was the IMF wanted to know at a high frequency level in the short term, what do we expect in terms of capital flows to emerging markets? So, we could, we have done a quantitative exercise on the COVID-19 shock to put magnitudes on, the distribution and across asset class. But once again, over there, we don't interact it with macro.
Thank you. Thank you.
We have a question from the audience, and I think you sort of mentioned this already. So basically, what are the data sets that can be used to measure macroprudential stance? I mean, you mentioned the IMAP. I mean, the IMF is the go-to place for that. You mentioned the IMAP database. That's, I think, sort of the gold standard now for measuring the macroprudential stance. So Danu, that's IMAPP.
IMAP, yes.
Yeah, database from the IMF. And that's sort of, anyone else? Any other questions?
I'll just add that there's the CCYB, you can get it from the European Systematic Risk Board, ESRB, and also the BIS. So that's, it's a quantitative measure. The IMAP is, it's a series of dummy variables that then you have to figure out net tightening or loosening.
That's pretty much all I can see. I'll give you another minute if there's sort of there's always a burning last minute question that comes in just as we're about to close. So I will preempt that by giving you another 60 seconds to type in that last minute question. But I think all the panelists are agreed that this is an incredibly rich, rewarding, sometimes challenging paper, simply because there's so much information to digest that I will certainly give it a second and maybe even a third read to sort of imbibe all the information that is in the paper. But it's been an incredibly interesting online seminar. So thank you, Anusha, for joining us today and for presenting this paper. you did a great job. I think we will also read at least one or two of your other papers.
The Roro paper especially.
Indeed. And I've started to mutter, but I'm only muttering because I'm trying to give people a chance to ask another question, but that doesn't seem to be the case. So I will bring proceedings to a close because you don't want to see me turn into a pumpkin in a couple of minutes. So Anusha, thank you so much for the paper and for the presentation. If you have another paper coming up, this is an open invitation for you to present your next paper, which hopefully is as interesting and as exciting as this one. So big thank you from the ASBxSEACEN Center. And
thank you.
And
thank you so much for inviting me. It was a real pleasure to present, and I would love to visit you all in Kuala Lumpur. Hopefully, you know, COVID will be in our rear view mirrors before too long. Thank you.
Thank you very much.
Thank you, Anusha. Have a great day.
Bye.
good night.
Bye.
Bye.
Thank you. Have a good evening. Bye-bye.
Stay safe
Bye.
and see you in April for our next seminar.
Okay, sounds good. Thank you so much for the invitation.
Thank you.
Bye.
Good evening.